Hi, everyone. We are having today with us Jose Murillo from Washington, from our national office, the Director of International Tax and Transaction Group in DC. Thank you, Jose, for joining us.
Thank you for having me.
So really, we want to spend the next session of the election in the U.S. and what we should expect. And I think we already read and already hear about the agenda of Biden. So I'm going to be good, the increase of the corporate tax from 21 to 28%, the interest of the guilty, the interest, the increase of the capital gain tax for individuals. Like, it all goes in the same direction. But based on the result of the elections or what we have now, do you really expect any massive legislation very soon?
Well, it's going to depend on the results of the January 5th Senate runoff elections in Georgia. Because at the moment, right, the Democrats have 48 Senate seats, the Republicans have 50, and so those two are outstanding. And so it really depends on that. If the Democrats win both runoff elections, and it seems unlikely that they would, then it would be equal 50-50 split with Vice President Harris would be the tiebreaker. And so, President-elect Biden would have sort of more flexibility, more control over what he gets accomplished. I would keep in mind, though, that his proposals have not been made as standalone tax legislation like the Tax Cuts and Jobs Act was. Instead, they are designed to raise revenue to pay for his other initiatives, infrastructure, bring jobs back to the US, et cetera. And so standalone tax legislation, unlikely, but if they do run the table in Georgia, then more likely that we would see significant tax legislation as part of a broader sort of package of laws.
So we will be clever more in January.
Yes, yes. Hopefully at the close of January 5th, unlike where we are today, we would know.
Okay, too bad it's not before December 31st.
Right, and then and then the other thing to keep in mind is as well, even if they do win both elections in Georgia, it's only 50-50, and at that point, right, they can't afford to lose one Democratic senator. So whatever proposals they would make, they need all 50 to vote as a block, and that as well is not absolutely certain.
So if it doesn't end in 50-50, then you don't really expect any massive legislation implementing this agenda.
That's right. Certainly not on a standalone basis. So if it's not 50-50, if the Republicans win at least one seat, then they would be able to block any significant legislation. And in that scenario, the thinking is, look, there are a couple of areas where there is bipartisan support around infrastructure, around build in America, around supply chains moving back to the US. Those areas where there is bipartisan support, where there can be some compromise, that will be the focus. How if at all, we pay for that, I guess, is really the interesting question. But I would expect, though, a lot of pushback or very little support from the Republicans on, for example, taking the 21% rate to 28, doubling the GILTI rate, separate country foreign tax credit limitations. The kind of more aggressive, more radical proposals likely would get very little support on the Republican side.
What about legislation regarding the extenders? I mean, we have the 954C6, the look-through rules that serves lots of our clients when payments are made from one CFC to another, interest, dividends, royalty. Now they all enjoy for several years now the look-through exception. It doesn't trigger Support F, and this is supposed to expire really in a month and a half, right? So
it is scheduled to expire at the end of this year. The tricky issue with tax extenders is that they need to find a vehicle to attach the extenders to, right? Some other bill, some other legislation that it can be incorporated in. That's how they extend them again. And at the moment, we don't have, there are not that many options. The continuing resolution, which is the spending to keep the government open, expires in about 1 month. And so when that happens, something else needs to occur. The hope is that as part of that process, extenders are added to that package to move forward. And so that is what most companies are hoping for. Here recently, we have heard that staff on the Hill is thinking about extenders and thinking about opportunities, vehicles to attach it to. And so we are still hopeful. If that doesn't happen and you are a calendar year taxpayer, right? So your year ends at the end of December, then it's planning that was done in the past in anticipation of it expiring, changing the tax year of your controlled foreign corporations, et cetera. There are a lot of companies that are already starting to put those contingency plans in place in case there is not an opportunity to get extenders done.
Got it. And what about COVID-19? I mean, on one hand, our clients are they hear about the Biden agenda, the tax rates are going to go up. So in that respect, the intuitive thing to do will be to accelerate income, defer expenses. On the other end, there is this very beneficial treatment of losses that is really unique for 2020. And in that respect, you do want to create losses that you can carry back, and you will want to accelerate expenses and defer income, which is exactly the opposite. So how do you see clients are dealing with this, really accelerating income and deferring expenses, vice versa, or what else do you see?
So I would say, a month ago, many were thinking really strongly about accelerating income, right, deferring expenses, especially given the polls out there that were saying it's going to be a Biden sweep on election day. I'm not aware of anyone who had actually, carried that through, actually accelerated income or deferred expenses. Where we are today, no one, maybe that's too strong of a term, but I'm not sure anyone who was thinking before about doing that is thinking about it now. Instead, everyone is being very cautious in the next several weeks. Your point on COVID, I think, leads into perhaps could we see another stimulus bill in the US? And the thinking is that yes, we will. I think the two sides were very close to a third stimulus bill before the election. The House wanted $2 trillion, which is a massive number. The Republicans wanted more in line of like $400 to $500 billion. At the end of the day, they were very close to like a $1.8 trillion bill, but agreement wasn't reached right before the election and it dropped. Now there are calls from both sides, including from Vice President Biden, to pick that up again. And the thinking is that we will see a third bill, maybe by year end, but certainly early next year. The other thing with tax legislation is even if they get a third stimulus bill passed, that's not the end of COVID. Like, we don't have a vaccine yet, and we have to shore up certain parts of the economy that were hurt the most by the pandemic and the shutdown. That's not going to be very quick. That could stretch out until mid next year, late next year, which I think puts a lot of pressure again on standalone tax legislation, increasing the rate. Is that the type of thing you want to do in that type of environment, which by itself puts a lot of pressure on what the Vice President Biden has been saying about changes day one. I think the reality and the things that he has to deal with in the near term probably push that agenda out further. And that's even before you get to the results of the election.
Right. But with the COVID-19, you may think they want to, maybe extend relief.
That's right.
On one hand, you want to increase the taxes to get resources. On the other hand, the relief, gives some breath to the businesses. So, but right now, there's a lot of uncertainty, I understand.
Yeah. The last comment I'll make on this is, we had put together a framework out of DC about how to consider sort of potential tax changes. And it was a multi-step framework. Step one was, hey, maximize the benefits of the CARES Act. So to your point, the CARES Act gave a very preferential carryback of net operating losses, right? You go back 5 years, you get the arbitrage, you go back to a higher rate and maximize the extent possible, right, those benefits. And there may be some pressure to extend that those preferential provisions an extra year or two, because there's still a lot of companies that are in those loss-making positions.
I think there are two more issues that I would want to touch. First, I mean, we are hearing about tax authorities become aggressive trying to collect revenues. Do you see the same thing happen in the US, like IRS become more aggressive or focus on other issues that were not the focus of audits before the COVID-19?
The IRS is starting, I don't want to say they're becoming more aggressive, but they are launching sort of national campaigns that are coordinated out of DC, especially around issues under the Tax Cuts and Jobs Act, TCJA, back in 2017. For example, the transition tax, the 965 transition tax, we're seeing very detailed, comprehensive information requests that are sent out as part of an audit, where they are, some of it is sort of diligence, like you reported X amount of earnings and profits, why was your inclusion a lot lower? And they want to understand the reasons for that. We are, though, as well seeing issues around BEAT and transfers of intangible property. So if they get more funding, and the thinking is that in a Democratic administration and a democratically controlled Congress, the IRS is going to get more funding, which is going to allow them to hire more people, improve their technology. Just by default, they're going to have more resources and get more aggressive because they're going to have the ability to audit more issues.
Mm-hmm. And then I think there's one provision that bothers many people in Israel with all the R&D centers here in Israel is, the Section 174, the capitalization of R&D expenses, especially the 15-year capitalization when the R&D happens outside the US. Can you give us some insights if there's some kind of lobbying or any prospect of change of this provision kicking in January 1st, 2022?
Yeah, that's a great question. Setting aside, for example, for a second, the Biden proposals, whoever had won the election, so whether it was new President Biden or President Trump, a second term, they both have a built-in tax agenda, because the TCJA, the Tax Cuts and Jobs Act from 2017, to your point, has a lot of scheduled changes, right? Provisions sunset, provisions sunrise, and this is, in the near term, the one that is most important. And if you recall, the TCJA was passed under some very odd rules that forced the legislation not to lose above a threshold amount of revenue. And if it did, then essentially a lot of provisions had to be temporary. And the way they managed to stay under that cap, and it was a really big number, $1.5 trillion, was to include all of these scheduled changes that affect the scoring, this one being a very significant one. I think there is bipartisan support to not let the change kick in. And there are a couple of draft bills that are being floated around in DC from both sides that would do just that. And the business community, as your question sort of implies, is very strongly behind not letting that change happen. To me, the question is how is it done? Is it deferred? Is it a deferral of the effective date, or is it a complete repeal? And at the end of the day, it's going to come to money. How much does it cost? A deferral is less expensive than a repeal, and the option it's chosen depends on what is going on at the time and sort of part of the broader package of legislation that this may be included in. So I think everyone at the moment is pretty optimistic that it's not going to take effect. Okay, good news. Maybe the last sentence, like as a recommendation to our clients about like kind of things that they won't regret if they do today, For example, I heard, if the agenda is to increase taxes eventually, I heard, if you're going to do a taxable transaction anyhow, you better do it by December 31st. Do you agree with that? Are there any other like should do or should not do by the end of the year? So the one area about acceleration is if you're going to close a deal, it's going to happen maybe within the first quarter of 2021, perhaps you accelerate it to to December, because you have no choice, it's going to get done. And in the outside chance that there are tax increases and they are retroactive, then you save. The other, although a lot of companies at the moment are cautious to take any big sort of decisions and undertake any big restructurings, everyone is modeling the provisions out, because I think the environment we are in is each year stands alone. You need a very good estimate of what your tax consequences are going to be. And so most multinationals in the US have stood up a model, whether it's our model, the ITS engine, or another model or an in-house model. You really need that to be able to appreciate, right, the impact of these provisions, because they're all interdependent. They kind of overlap and they're very related. And you need something like that, right, to really get a handle for what your consequences are going to be, as well as to take into account, right, the schedule changes. We talked about the R&D change, but the beat rate is going to go up. The earning stripping limitation is going to go down. And to really project the consequences of all that, you need a pretty good modeling tool.
Absolutely. So thank you very much. Your insight was very important, and thank you for listening.
Thank you.